Paul Bloxham, he is HSBC's chief economist for Australia and New Zealand and formerly of the Reserve Bank there as well. Paul, thank you very much indeed for joining us. Let's get your view as to the message coming out of the RBA.
Yes, well, I think there are two key forces driving what's happening with the banking system in Australia at the moment. The first is, much like the rest of the developed world, households have become more cautious and are doing more saving and doing less and borrowing less from banks. So we've seen household credit slow down. The second big force is that the business sector is being driven by the miners. Mining investment is the big driver of growth here at the moment, and they don't tend to borrow very much from the banking system. So both of those forces have come together to mean that credit growth is fairly slow here, and of course that means that as banks are looking to improve their profits, they might be looking to take on more risky borrowers, and that's what the Reserve Bank was all about today in terms of warning the banks not to do that, to continue to be fairly prudent in their lending standards. We think they have been, and the Reserve Bank thinks they have been, and so does the prudential regulator, but they're warning them not to let that slip.
Well, that's the point, isn't it? I mean, you say credit growth has been slow, and that's partly down to these banks as well, because they haven't been, for instance, passing on some of the rate cuts that the Reserve Bank's actually instituted as well, for fear of course, their balance sheets not being up to scratch.
That's right. So one of the things that's happened, of course, is our banks in Australia are still fairly exposed to offshore wholesale funding markets. Not so much as they were in 2008, though. If you look back then, about a third of their funding came from offshore wholesale funding markets. It's now down to around a fifth, around about 20% of their funding comes from those markets. And, of course, with the European financial crisis late last year blowing out the cost of funding, that did hit the banks in terms of their funding costs. And what we've seen is when the Reserve Bank has cut rates, we haven't seen complete pass-through as the banks have sought to protect their margins somewhat. So that of course, is part of the puzzle. It is part of the story. It means that they do get slower credit growth because they're holding interest rates a bit higher.
Paul, also, I mean, you know, underpinning this is what you just mentioned as well, and that, of course, you alluded to the two-speed economy. How does that play out in this? Because, as you said, they don't really need to borrow that much because they have pretty much funded a lot of these mining groups.
Well, I think the way it plays out is we're likely to continue to see fairly sluggish credit growth in Australia. But that doesn't necessarily translate into weaker growth in the economy. The economy is being driven by parts of the economy that don't need to borrow from banks, the miners being a major contributor to that growth at the moment. So it does look as though it'll continue to be fairly tough times for the banking system, in the sense that credit growth is likely to stay slower than it has been in the past. But as I say, that doesn't necessarily reflect on tough times for the economy overall. It's just a different composition of growth that we're seeing now.
Well, it is that different composition of growth which also presents one of the biggest challenges facing that economy, and that is how do you share the love, how do you share the wealth there? Well, you've got one side of the economy which is, of course, booming, and another side which is looking, well, a bit stale, really.
This is certainly true. We're expecting around trend growth in the economy this year, but we're expecting that 20% of the economy, what we're calling the part affected by the mining investment boom, will grow at over 10%. While the rest of the economy, the other 80%, we expect to grow at only a little over 1%. So it certainly is the case that Australia very much has a multi-speed economy at the moment. Managing that is tricky. The way it's working at the moment is the market is doing it. The strong exchange rate is slowing down some parts of the economy, the tourism industry, the education exporters, the manufacturing industry, while the mining boom is playing out and pushing up that part of the economy. There isn't an awful lot else that's that's allowing redistribution across the economy. Really, it is being left to the market to determine, and that really just does mean that the economy is changing in its structure.
Surely the Reserve Bank should be slashing rates more than it has been.
Well, the Reserve Bank's taken the view, as it should, really, that it's targeting inflation. It has a singular target, it has a singular instrument for achieving that target, and inflation so far is sitting at the moment around the middle of the Reserve Bank's target band. Now, should inflation start to fall a bit further, the Reserve Bank may feel that they can cut rates a bit further, and indeed that's what we expect. We expect that the weaker parts of the economy will outweigh the stronger parts in the short run, such that we see the unemployment rate rise a little bit further from here, and we do see the RBA cutting a bit further. We think that that'll probably most likely happen after we see the next CPI print. Not this coming week, but we think the next cut will probably be in May. But we don't think they've got a whole lot further to go, because overall the economy, as I said before, is still looking as though it'll grow around trend, supported by that mining boom.
Paul, thanks so much for your time. Thanks for stopping by. Paul Bloxham there.